Fortitude. It's a word that embodies strength, resilience, and an unyielding spirit.
Welcome to Fortitude Family, where future legacies are born. Today, we're diving deep into The Intelligent Investor by Benjamin Graham.
Oh, a classic.
It is, and Warren Buffett considers it the best investment book ever written.
I can see why.
Yeah. So we're going to distill 12 key lessons from this investment Bible.
Sounds good.
Whether you're a seasoned investor or just starting out, this deep dive is for you.
The beauty of The Intelligent Investor is that it stood the test of time.
Absolute.
Written decades ago, but the principles still hold up today. Amazing.
Yeah, that's what makes it a classic.
Yeah.
Okay, so let's jump right into lesson number 1.
Okay.
It's about you, not the market.
Right.
Graham emphasizes that investing success isn't about being a genius.
It's about having the right temperament. Like, imagine making 250% on a stock in a single day.
Oh, wow.
Feels amazing, right? But then, months later, that same stock crashes, becomes worthless.
Oh.
How would that feel? Devastating.
Yeah.
Yeah.
Even the greats experience these wild market swings.
Yeah.
That's why lesson 1 is about building that mental fortitude to weather the storms.
Yeah. So it's about controlling our emotions and not letting fear or greed take the wheel.
Precisely. This leads perfectly into lesson number 2. Investor, know thyself.
So what's the wisdom behind know thyself?
Right.
Is it some ancient Greek philosophy applied to investing?
Yeah, well, it does have a timeless ring to it, right?
It does.
But in investing, it means understanding the difference between investing and speculating.
Oh, okay.
Are you buying a solid business or just chasing a hot stock tip? Are you holding for the long term or are you gambling on margin for quick profit?
I've definitely been guilty of chasing hot tips before. It's like that FOMO feeling,
Right.
fear of missing out on the next big thing.
Yeah, and that fear is exactly what can lead to that speculative behavior.
Yeah.
Remember, in 1948, when most people saw the stock market as just this risky gamble,
They were about to miss out on this massive boom. Their fear kept them from understanding the true potential of investing.
wow, that's a great point. It's like they let their emotions cloud their judgment.
Absolutely.
Yeah.
Speaking of things that can cloud our judgment, let's move on to lesson number 3. Inflation's bite.
Okay. I know inflation can be a silent wealth killer,
It is.
slowly eroding our purchasing power over time.
Absolutely.
But didn't Graham say something about common stocks not being a perfect shield against inflation?
That's right. It's tempting to think stocks will always keep pace with inflation.
Right.
But what happens when company profits don't rise enough to offset those rising prices?
So even if the stock price goes up, we might not be actually gaining purchasing power.
Exactly. He uses this fascinating example. Between 1950 and 1969, corporate debt increased 5-fold, while profits barely doubled.
So debt was skyrocketing, but profits weren't keeping up. That's a recipe for trouble.
It is. It highlights the need to look beyond just stock prices and consider the real value of the underlying business.
So what's the takeaway for us today? How can we protect ourselves from inflation's bite?
Consider adding assets like TPS, Treasury inflation-protected securities to your portfolio. They're like inflation insurance for your retirement.
Inflation insurance, that's a great way to think about it.
Right.
All right, on to lesson number 4. The S&P 500 isn't always right. I think a lot of people assume the market always knows best.
Right.
But Graham challenges that assumption.
Think about the dot-com bubble in the late 1990s.
Yeah.
Everyone was pouring money into tech stocks. There was this feeling of euphoria, like the market could only go up.
Yeah, and we all know how that ended, right?
Yeah.
The bubble burst, and a lot of people lost a lot of money.
Exactly. By 2002, the U.S. stock market had lost over 50% of its value. Graham's point is that when everyone seems to think stocks are a sure thing, that's when you need to be extra cautious.
That's like that old saying, if it sounds too good to be true, it probably is.
It probably is.
Yeah. So sometimes being contrarian, going against the crowd, can be a good thing.
Absolutely, especially when the market is driven by hype and speculation rather than sound fundamentals. Now, this leads us to lesson number 5. Defense wins championships.
Okay, I love that analogy.
Right.
But how does defense apply to investing?
In investing, defense means prioritizing the preservation of capital. It's about minimizing losses, especially for those who aren't actively involved in the market or who lack the time or the expertise to constantly analyze investments.
So it's like having a strong defense in football,
Yeah,
protecting your end zone from those risky plays that could wipe you out.
exactly. And part of having a strong defense is avoiding those common traps.
Okay.
Graham warns against the buy what you know trap. You might think investing in familiar companies is safer, but familiarity can breed complacency.
But isn't buy what you know good advice?
Sure.
I mean, Peter Lynch swore by it.
He did. But remember, you're not Peter Lynch. He had access to resources and information that most individual investors just don't have. Think about it. You might love a certain coffee shop, but do you really understand its financial statements, its competitive landscape, or its long-term growth prospects?
That's a really good point. I've definitely fallen into that trap before. Investing in companies just because I like their products.
Yeah, and that's why Graham stresses the importance of doing your research,
Right.
understanding the business behind the stock, and not letting familiarity cloud your judgment.
So defense wins championships by protecting our capital and avoiding those emotional traps that can lead to bad decisions.
Exactly. Now, speaking of avoiding traps, let's move on to lesson number 6. Don't try to time the market.
This is something I struggle with.
Yeah.
It's so tempting to try to predict when the market will go up or down and buy or sell accordingly.
I know. It seems like everyone's looking for that magic formula to time the market perfectly.
Right.
But Graham argues that it's nearly impossible to consistently pick those perfect entry and exit points. Even professional investors struggle with this.
So those market timing newsletters that promise to predict the next big move, are they just a waste of money?
Let's just say their track record isn't that impressive. Graham uses these newsletters as an example, pointing out that even the best ones couldn't beat a simple index fund over time.
Wow, so all that effort to try to time the market, and you could have just bought a simple index fund and done better.
It highlights the importance of focusing on a long-term strategy rather than trying to outsmart the market.
So instead of trying to time the market, what should we be focusing on?
Lesson number 7. Diversification is key. It's one of the most fundamental principles of sound investing. Don't put all your eggs in one basket, no matter how tempting it might seem.
It seems so obvious, right? Don't put all your money into one stock. But why do so many people still make that mistake?
It's that temptation to go all in on what you think is the next big thing. We all want to find that one stock that's going to make us rich.
Like betting all your chips on a single number at the roulette wheel.
Exactly. Graham uses these famous examples of concentrated wealth, like Bill Gates in Microsoft or Sam Walton in Walmart.
Right.
To illustrate this point, yes, they achieved incredible success, but that level of concentration is incredibly risky.
Yeah, except for every Bill Gates, there were thousands of people who bet big and lost it all.
Precisely. For most investors, diversification is a much more prudent approach. It's about spreading your risk across different asset classes and industries to protect your portfolio from those inevitable ups and downs of the market.
Makes sense. Don't bet the farm on a single horse race.
Right.
Spread your bets and increase your chances of winning.
Exactly. And speaking of the ups and downs of the market, let's move on to lesson number 8. Mr. Market is your servant, not your master.
Okay, I've heard about this Mr. Market concept before.
Yeah.
Can you explain it for our listeners who might not be familiar?
So imagine the market is a person, a rather emotional fellow named Mr. Market. Every day he shows up at your door, offering to buy or sell stocks at these wildly fluctuating prices. Sometimes he's euphoric, other times he's depressed. His moods swing all over the place, just like the market itself.
So it's like the market is this unpredictable character who's always trying to tempt us into making impulsive decisions.
Exactly. Graham's advice is to ignore Mr. Market's mood swings and focus on the underlying value of the businesses that you're buying.
So don't let his fear or greed rub off on you.
Exactly. Remember that example where the Wilshire 5000 gained nearly 24% in 1999? But over 3,700 stocks within that index actually went down that year.
Wow. So even in a strong bull market, individual stocks can still go down.
It highlights the importance of not getting swept up in the overall market sentiment
Very.
and making your decisions based on the individual merits of each investment.
So how do we become the master of Mr. Market and not the other way around?
By focusing on the things you can control, your savings rate, your investment costs, your emotions, and sticking to your long-term plan.
Okay, so it's about being disciplined and not letting Mr. Market's crazy antics dictate our actions.
Precisely. Now, this next lesson might make some people uncomfortable. Lesson number 9, the truth about mutual funds.
Okay, hit me with the truth. What did Graham have to say about mutual funds?
He believed most mutual funds don't beat the market.
Hmm.
In fact, he argued that they often underperform due to high fees, frequent trading, and a tendency to chase hot stocks.
So all those fancy mutual fund managers with their MBAs and algorithms,
Right.
they're not necessarily outperforming the market.
That's right. And back then, fees are even higher than they are today. Graham was particularly critical of funds that focused on growth stocks, arguing they often overpaid for that future earnings potential.
So what's the alternative? Where should we be putting our money if not in actively managed mutual funds?
Well, in his later years, Graham came around to the idea of index funds as a sensible option for individual investors.
Index funds. Those seem pretty boring compared to these high-flying mutual funds promising huge returns.
They might not be as exciting, but they're much more effective.
Okay.
Index funds simply track a specific market index, like the S&P 500. Their low costs and simplicity make them a powerful tool for long-term investors.
Plus, Warren Buffett's a huge advocate for index funds.
He is.
If it's good enough for the Oracle of Omaha, it's good enough for me.
Exactly. Now, lesson number 10, finding the right advisor. This is for those who don't have the time or the inclination to manage their own investments.
So what advice does Graham give for those who want to seek professional guidance?
First and foremost, ask the right questions. What is the advisor's investment philosophy? What is their track record? How are their fees structured?
So it's like interviewing someone for a job.
It is.
You want to make sure they're a good fit for you and your financial goals.
Exactly. Graham warns against blindly following the recommendations of brokers or financial advisors, especially those who are more interested in selling products than in providing sound advice.
So what are some red flags to watch out for?
Be wary of anyone claiming to have a crystal ball or guaranteeing specific returns. No one can predict the future, right? Instead, look for advisors who focus on long-term results, have a transparent fee structure, and a proven track record that you can independently verify.
Makes sense. You wouldn't hire a surgeon without checking their credentials, and investing is no different.
Precisely. Now, lesson number 11 focuses on a specific asset class: bond safety.
Okay, I'm listening. Bonds are generally considered less risky than stocks.
They are.
But what should we be looking for to ensure our bond investments are safe?
Even though bonds might seem safer, they still carry risks. Graham uses the early 1970s as an example. Many companies were overloaded with debt back then,
Oh, wow.
creating both opportunities and dangers for uninformed investors.
So even in the bond market, you can't just assume everything is safe and sound.
Exactly. He emphasizes the importance of looking for bonds with consistent earnings coverage, meaning the company's earnings should be significantly higher than their interest expenses.
So if a company isn't earning enough to cover its debt payments, that's a big red flag.
Absolutely. He uses railroads as an example. He says a railroad company should have earned its fixed charges at least 5 times before income tax for its bonds to be considered investment grade.
So that 5 times coverage acts as a buffer against potential downturns in the railroads business.
Exactly. And it's not just about railroads. This principle applies to any company issuing bonds. You want to see a healthy margin of safety between their earnings and their debt obligations.
Okay, so just like with stocks, we need to do our homework on bonds,
Absolutely.
looking beyond the yield and digging into the company's financial statements.
Precisely. And that brings us to our final lesson, number 12. Earnings can be deceiving.
Interesting. How can earnings be deceiving?
Right.
Aren't they supposed to be a clear indicator of a company's profitability?
They should be. But companies can sometimes use accounting gimmicks to make their earnings look better than they actually are. Graham cautions against being fooled by single-year earnings figures, especially those that are heavily manipulated.
So just because a company reports a big jump in earnings, that doesn't necessarily mean it's a good investment.
Exactly. You need to look beyond the headlines and dig into the footnotes of those financial reports. Understand how the company is generating its earnings and whether those earnings are sustainable.
So it's about being a critical thinker, not just taking reported earnings at face value.
Exactly. He uses the case of LCOA in 1970 as an example. They reported multiple earnings figures that painted a confusing picture, making it difficult to determine the company's true profitability.
So we need to be detectives, scrutinizing those financial statements, looking for clues that might reveal the true story behind the numbers.
Exactly. And remember, if it seems too good to be true, it probably is.
Well, there you have it, folks. 12 essential lessons from the intelligent investor. And for our dedicated Fortitude family members who stayed with us through this entire deep dive, I want to leave you with a bonus principle that Graham emphasizes throughout the book. The risk is not in our stocks, but in ourselves.
That's such a powerful reminder.
We can have the best investment strategy in the world, but if we let our emotions get the best of us, if we panic during downturns or get greedy during bull markets, we're setting ourselves up for failure.
So the key to success is not just about picking the right investments, but also about mastering our own minds.
Exactly. We need to cultivate patience, discipline, and a long-term perspective. We need to be aware of our own biases and tendencies, and most importantly, we need to remember that investing is a marathon, not a sprint.
By focusing on these principles, we can all become intelligent investors and build a brighter financial future for ourselves and our loved ones.
Thank you for joining us on this incredible journey through The Intelligent Investor. We hope you found it insightful and empowering, and as always, thank you for being part of the Fortitude family.
Remember, building a lasting legacy, it's a journey, not a destination. It's about making conscious choices every day. Choices that align with your values and contribute to a brighter future for generations to come.
Don't forget to click the like and subscribe buttons to stay up to date from Fortitude family. We'll be back soon with more insights on building legacies that last.